there are these elements where you can tweak things, and where you might want to do those tweaks because it's a free lunch. And what do you mean by a free lunch?
Free lunch is where you can increase your withdrawal rate without taking any additional investment risk. Basically, it's a free higher withdrawal rate. And the first one, the list diversification, I think everyone understands that pretty thoroughly. That's a common theme among almost all money managers. Diversify, allow the asset classes to work with each other to increase the return of the portfolio. Because as different assets move to peaks and troughs at different times, and the combination of the two is very beneficial. Rebalancing is an important
And
rule.
just to kind of put a fine point on that,
Sure.
that's what allowed the 4% to go to 4.7. Was that diversification free lunch?
Absolutely.
Yeah.
Yep.
So,
And then may get us to 5 eventually. We'll see.
okay.
We're working on it.
Uh-huh.
Rebalancing, of course, means just simply returning your portfolio to the original allocation when you started. If you have a 60-40, after a year or two, probably stocks have grown to 65 or 70. Trim that back. That prevents your portfolio from reducing too much risk, and also has a favorable effect of buying assets that are out of favor. Because you rebalance, that's what you have to do, and selling assets which have done very well and probably about ready to do less well. The third one, they're favoring small and micro caps. They're the two highest returning asset classes. So based on past data, at least, if you just slightly increase your exposure to those above your average, you'll improve your withdrawal rate. There are some questions about small cap stocks in terms of what's happening in the marketplace, where a lot of the best small companies are being siphoned off by venture capital, private equity before they get to the fund manager. But that's why I recommend using an active fund manager who can pick the best companies in that universe. I don't think it makes sense to hold an index of junk, you know. And the last is something called increasing glide path, or which is the development came out of a paper written by two super advisors, Michael Kitces and Wade Fowle, back about 12 years ago. And they studied the idea, what if I was to start with a little bit lower asset allocation, 60%, and then I was to increase it each year? What kind of effect would it have? And it turned out their research indicated it had a beneficial effect in almost every case, and my research backs it up. And it's kind of curious to know why it would do that, but they think, and I have to agree, it's because if you encounter a major bear market early in retirement and your allocation of stocks is lower, you're going to have less damage done. Meantime, in subsequent years, you're raising your allocation, you're buying into the stock market acceleration. So that's probably the reason for that beneficial effect.
But what about the other side? What about, does that mean your withdrawal rate is lower if you are fortunate enough to have a good market your first few years?
I'm sorry, with a glide path, it should raise almost all withdrawal rates across the board.
Right, but you were kind of giving the scenario of if you had a bear market kind of early in your retirement, it makes sense why the increasing glide path would be better. But what about the flip side? What if you're fortunate enough to have a good bull market to start out, and then you're increasing the glide path down the road? Is that still okay?
It doesn't work as well as the increasing glide path. The increasing glide path, I compared it to all 100 of my retirees, some of which had early bull markets, some of which had late bull markets, and the glide path beat every one of them. At least those, the allocation of stocks I was studying at that point was 55% fixed stock allocation, comparing it to a glide path, which began at 45 and went up to 70, let's say. Since then, I've been working on 65% stocks, and the comparison still is in favor of the glide path, but not overwhelmingly as it was in the case of the 55% stock fixed allocation.
And what's strange about this too is, and again, you and your cohorts have got some data to back this up. At least, again, past performance is not indicative of future results, but the common wisdom is usually that as you go through retirement that you're doing the opposite, right? That you're decreasing your allocation to stocks. But what your data is showing is kind of the opposite, right?
That's exactly right. In fact, one of the first things I tested was reducing your allocation of stocks back in the early 90s, and that was a disaster. That did
Okay.
not work too well. But I never, to the credit of Wade Fowl and my kids, I never thought of looking at a rising glide path. I just couldn't see how it would work. It does. So
I'm
lucky they did it.
And I guess this is, again, there's so much uncertainty with the future. There's no crystal ball here. But it's worth reminding our listeners that, again, this 4.7% number that you came up with, that gets you through the worst case scenario that we've had so far. So what existed for the one retiree in 1968, everyone else, had a better outcome. But I guess, the question is, people might still have that fear of, well, gosh, what if something changes and I outlive my retirement? So what kind of margin of error do you think people need to do to kind of give themselves that comfort?
Yeah, I think the tool I can use to help most with that issue is adjusting their planning horizon. And planning horizon is not identical to life expectancy. There's quite a difference. You can look up your life expectancy on the internet, come up with a number. Let's say it's 25, 30 years. I'd recommend in that case your planning horizon be at least 30 to 40% longer than that, maybe out to 40 years, to give yourself a margin of safety in case you live a lot longer than you figured you would.
Mm-hmm. And what about the fire folks? Those that are going for that financial freedom early in life. They want to retire early, and so they're looking at maybe a longer horizon in which they want to be retired. How does that change the numbers? Is it dramatic?
Sure. A longer planning horizon means lower withdrawal rates. The good news for the fire folks is that the decline slows as you get longer and longer horizons, and eventually just about stops. So that it'll hit a floor. If we're at 4.7%, for a 30-year horizon, then a 70-year horizon might be 4.1%, and it's not going to be lower for 100 years or 120. So those folks who retire at 25, have something working for them there.